Hey folks, Scott Rinehart here, and today we are talking about rules of thumb in retirement. These are those very popular things that we see in the news. Read articles about these rules of thumb, and so we're just going to talk about what they are in a little bit of detail and just give you our thoughts on what we think of these rules of thumb. So the 4% rule is the first one we're going to talk about. We hear a lot about this one, and it just means that you can withdraw 4% of your total investments in year one of retirement. And then as you go, you adjust for inflation and you take 4% out each year off your portfolio. And you shouldn't run out of money if you do that. So just as an example, for every $100,000 you have saved, you can withdraw $4,000. If you have $1 million saved, you can withdraw $40,000. Now, some problems with 4% rule. It's a set it and forget it strategy. So you do nothing along the way except just withdraw the same 4%. It doesn't account for things that might come up where you need to take a little bit more out, or on the flip side, if you don't need to take as much out one year. So that's the second bullet point there. It doesn't account for the timing of other income streams. Sometimes early in retirement, you haven't started your Social Security yet. So you need to take a little bit more than 4%. But then later, you may not have to take as much. And another problem with the 4% rule is that it's based on historical data that might not apply to the future. And let's be honest, it probably won't apply to the future. So I've heard that this 4% rule could be the new 3% rule or 2.5% rule. But a lot of times when we build a financial plan, we can build a plan where someone can withdraw more than that. So it just really depends on your situation. So next is the 100 minus your age rule. So what this says is that you take 100 minus your age, and that should equal the percentage you should have in stocks. So if you're 60, you would have 40% in stocks. If you were 70, you'd have 30% in stocks. We're not big fans of this rule of thumb because it just doesn't account for your unique situation and risk tolerance. I would say a lot of our clients have a little bit more than this in stocks. Some have less if they're just way more conservative. But, we've also seen research that says this 100 minus your age rule has turned into the 110 minus your age rule because life expectancies have gone up and interest rates have gone way down. So you're just not going to get as good of a return on the safer allocation. So you need to have a little bit more in stocks to hopefully get the same return that you could have got in the past. So that's something that we have to talk to you in a meeting, make sure you understand why we're taking maybe a little more risk than what this rule of thumb might say. And then finally, there's the 80% of your income rule. It assumes that in retirement, you'll need to replace 80% of your income you had while working. And while this is a good starting point, it just doesn't account for those things like early in retirement, you're going to take more trips, or maybe you're going to help grandkids out with college. It doesn't account for some people are big savers while they're still working. Maybe they're saving 20, 25% of their income, and then you retire. Well, you don't need anywhere close to 80% of your income because your taxes went down. You were saving 25%, so you might only need 65 or 50% of your income. And so if you were going by this rule of thumb, you would have delayed retirement way longer than you needed to. So that's why it's just important to sit down with a financial planner and get those things figured out. Have someone build a plan for you and figure out your unique situation so that you don't have to rely on rules of thumb that are really just there to be a starting point. They're not meant to live by necessarily. So if you want to discuss any of these things, you know where to find us. Give us a call, 844-CARLSON, or go see us at carlsonfinancial.com. Thanks and have a good day.